Welcome to the Crystal View Capital Fund 4 update. We are glad you're here. Today, we're going to be going over a quick overview of what the fund is, what's in the fund, and kind of some of the targets here. But then we're going to go a little more in the weeds and get specific on some of the great updates that we have in the fund and the things that are going on right now. As we dive in here, it is important to note that this presentation is confidential. Please do not share this without the permission of Crystal View Capital. Past performance is no guarantee of future return. This fund and presentation here is designed for educational purposes only. This is not a solicit for sale. This is just an educational presentation here for you today. Well, let's dive in to the fund itself. Now, this is a manufactured home self-storage fund. Our target size is $200 million. Currently, we brought in about $35 million. We are quickly raising capital for this fund. The minimum investment is $50,000. Our target returns are a 15 to 20% IRR. Now, past performance is no guarantee of future return. However, our first fund, which has been fully exited, generated over a 40% fund level gross IRR. So some pretty stellar returns there within the first fund. Fund 2 and 3 are still in operation. Fund 2 is on chart to hit kind of low 30s IRR. Fund 3, kind of high 20s, low 30s is what we're looking at there. So some pretty great historic returns in our funds. Now, the preferred return here within Fund 4 can range anywhere from 7 to 9%. Now, that depends on your funding amount. $50,000 investment would get you that 7% preferred return, and it kind of ladders up from there. We're happy to chat through the details of that if you do have any questions. All said and done, our portfolio size, by year 3-ish, we're looking at a $300 to $400 million portfolio. Now, the specific asset count, how many assets we have, and the makeup of those assets, what's MHC community, what's self-storage, that might change a little bit over time. We are working hard to acquire as many properties as we can, as quickly as we can, that hit our underwriting criteria. Now, we've got a strong alignment of interests here. Our manager has committed to funding over $1 million into this fund. So a significant investment. Now, that is an LP investment. That means that our manager is investing under the exact same terms as any LP would, as you and I would if we were to enter this fund. So we get it. We know the concerns of LPs. We are LPs ourselves. Now, the distribution terms, we pay out distributions on a quarterly basis. Now, that's based on cash flow, but we have been sending out distributions here in Fund 4, and we plan to continue to send those distributions out. The fund is designed to go up to 10 years. Now, we do have the option to extend that if needed, but plan for a 10-year fund. And then great news here is that because we have such a robust acquisitions pipeline, we are able to convert capital in this fund very, very quickly and efficiently. We do not feel that investors will have to wait on the sidelines for very long to get your capital converted. We've got a robust acquisition pipeline here in the fund. Now, with that overview, I am going to turn it over to Matt and Mike to give a little more specific detail on the fund and what's going on.
Thanks, Matt. My name is Matt Radella. I'm the managing partner of Crystal View Capital Fund 4. I want to thank everyone for being here with us this afternoon or this morning, wherever you're dialing in from. I want to take a moment and just take a look at a quick snapshot of our Fund 4 portfolio as of today, which Ben alluded to just a moment ago. We're very happy with a lot of these assets are actually performing ahead of projections. So we're pleased to announce that today. But I'm going to get into some of the details. Right now, we have 13 different investments across the portfolio. 2,197 of them are self-storage units. That consists of around 256,000 square feet, 786 manufactured housing sites. Total AUM is 43 million, which is essentially our cost basis for all the assets that we've acquired in Fund 4. Taking a look at our cost basis and where we acquired these assets, this is often a question we get being a value add firm. What cap rate do you buy your investments for? Well, it's not an easy, there's no simple answer to that question. Basically, what we're looking to do is drive value and hit the 7.5, 8% cap rate, let's call it within 6 to 18 months of our ownership of that asset. So on average, we've acquired Fund 4 assets for about a 4.6 cap. That's roughly 1.9 million of in-place NOI. As of today, I'm happy to report our yield on cost on those different investments is 7.2%. So essentially what we've done is we've taken a 4.6 cap at our acquisition, and we've created value across that portfolio. And as we sit here today, we're at about a 7.2% cap rate. So that's obviously going to put us in a position to deliver pretty nice sized returns to our investors. And I think, this is a really important point. The reason why we're able to do this, I think it all comes back to the vertical integration. If we weren't sourcing these deals off market, if we didn't have an in-house asset management team, which was driving value, if we really didn't have our thumb on the pulse of what we were doing and have that alignment of interest as being LPs and thinking about this like an owner, I really do not believe, in fact, I know we wouldn't be able to achieve that level of return. So that just comes back to that crystal view edge. Looking at it from a growth perspective, from where we acquired these assets to where we sit today, about 68% NOI growth translates into $1.3 million. Today, we have about 3.2 million, give or take, in NOI. That's the existing run rate. And I will footnote that includes 4 investments that we just acquired that we haven't executed the value add business plan on, but they are in various stages of that value add plan. And we're highly confident that we're going to hit those projections. You're going to see in a minute, some investments are, again, exceeding projections. Our leveled cash yield on these different investments that we own within the portfolio is 7.4%. So those of you that are present investors of Fund 4, you'll know that last quarter, we actually distributed a 6.3, 6.4% cash yield. That's actually increased since our last reporting. Total value add across the portfolio, if you look at what we've done and these different initiatives, about $20 million of value add since these investments since we've acquired them. So we're very, very happy on where we sit today, and we're really excited about what the future holds, not only for the existing portfolio, but also some of these great new investments that we're looking to add into the portfolio. So let's take a look at some of these investments and talk about how we were able to deliver this value add. It's a pretty good size number in a relatively short period of time. I mean, bear in mind here, we didn't really launch Fund 4 until 2023. So that's a pretty nice ramp up in, again, we're looking at about 18 months, give or take. So let's take a look at 2 investments. And most of you that are on this webinar have gotten the portfolio update on our Michigan portfolio and what we've done and some of these value add initiatives. I'm very happy to announce that from our cost basis, within a relatively short holding period, and when I say relatively short, we're talking about 4 to 6 months on these 2 investments or on this portfolio deal, we created north of $6 million of value in just 4 to 6 months of ownership. And the way we did that is we increased lot rents on average 30% since our acquisition. It comes back to a lot of these investments are purchased from smaller operators, a lot of mom and pop operators. Our team was able to identify that rents were grossly below market. We brought them to a market level. In addition to that, we actually took a look at the utilities, and this is a really nice value add initiative. Team did a fantastic job in identifying water, sewer, and actually cable was being included in the rent. We actually passed that expense through, resulted in an additional $184,000 of NOI dropped right to the bottom line. Once again, $6.1 million of value creation at a 6.5 cap. So really, really happy with that. We're bringing these two assets into our Fund 4 revolver. I won't steal Mike's thunder. He's going to talk about our revolving credit facility and how that works in a moment. And we're not done, by the way. We've got ongoing value add initiatives here. We've just ordered 5 brand new homes. We're bringing them into one of these communities. Very nice resale market here. A lot of demand from tenants that want to own homes within this community. We feel very confident in our ability to sell all of these homes by the end of the year, which, by the way, isn't even included in that $6.1 million figure. Conservatively, that would bring us another $500,000 of value. And from there, we'll continue to bring more homes in and create more value. So in closing, this Michigan portfolio was a great add-on for Fund 4 investors. Let's take a look at a storage deal. We've got a lot of negative sentiment out there about storage. I know a lot of you have read recent Wall Street Journal headlines and a lot of headlines across the industry where self-storage is not doing well right now. It's oversupplied. Revenue is shrinking, occupancy is going in the opposite direction. And I will say some of that is true, but it's dependent. And it's dependent on ownership, it's dependent on management, it's dependent on geography. And I want to say, here at Crystal View, we're bucking that trend to a certain extent. And this particular property shows exactly that. This property is actually, and those of you who know us and who have been invested with us across our prior vehicles know that we're very conservative in terms of our underwriting. And I think this property really demonstrates that well. This is called Alice's Attic. We acquired this property fairly recently. Again, this was an acquisition that took place within the last 8 months. Our initial underwriting projected a 28% increase in our rental charge. We are actually sitting at a 31% increase as of today. So we've already created $2 million of value at this particular storage facility at a 6.5 cap. Not to mention, let's take a look at NOI for a moment. We initially underwrote being at about $306,000 of NOI at this point in time, and we're way ahead of that at $374,000. So, we've created $1 million of value, not since acquisition, but how we underwrote the deal. So all inclusive, you're looking at about a $3 million value add on this one investment, and we're not done. We're pending, as you could see, the bullet point on the bottom, tenant insurance, which we're going to roll out to new and existing tenants. And there's a lot of demand in this market. It's a smaller market in New Mexico. As that demand remains, we're going to continue to push those rates, push those revenues, and this property is going to consistently kick off a really nice cash flow to Fund 4 investors if this trend continues. So I think this is a good opportunity, again, to demonstrate our conservative underwriting and also that not all storage investments are doing poorly. There's a lot of them in our portfolio in Fund 4 and Fund 2 and Fund 3 that are performing extremely well. So let's talk about that acquisition pipeline. Common question that I get from investors is, what allocation are you going to put for storage and manufactured housing in your portfolio? And that's a difficult question to answer. we like to say, look, we're here to deliver value and add value to our investors in either asset class as we see fit. However, with that being said, you could see that this acquisition pipeline is fully, existent of manufactured housing communities. So 100% of the acquisition pipeline is all mobile home communities at this point in time. We're really excited about that. I know our investor base is really excited about that. Our asset management team is been reconfigured in the sense that we're set up now to really add in homes and fill those vacant sites where we didn't have those competencies before. So we have a whole new lever to pull in terms of value add and value creation across the MH portfolio that we didn't have, let's say, 2-3 years ago. We're really excited about that. You could see we've got about $75 million of deals that are under contract and we're in active contract negotiations with. 1,311 sites scattered across the United States, with an emphasis on the Midwest and the Upper Midwest. Projected IRRs conservatively across this pipeline, roughly 20%, 19.7%. Projected MOIC, the multiple on our invested capital, 2.3 on average. We're projecting a year one rate increase at about 16.5, and cash on cash across this pipeline, if we're successful in acquiring all of these assets, is 5 to 11%. Some of you may ask, well, why the spread there? 5 to 11 is a pretty wide gap. Yes, as you know, we're acquiring these assets at sometimes very low cap rates. We're executing a business plan, and we're taking these assets up to a lot higher cap rate, which is resulting in a higher cash on cash. That period could take 30 days, it could take 6 months, it could take 12 months. Each investment is a little bit different, but you could see on average, we're ranging on 5 to 11% here, which is pretty nice buffer to hit those cash on cash returns, which is going to allow us to hit those preferred returns moving forward. So with that being said, I'd like to go ahead and pass this over to our CFO, Mike Hamill, who's going to talk about some of the existing debt across the portfolio and some of the existing cash flows. Mike?
Yep, appreciate that. Thanks, Matt. And thanks, everybody, for joining. And picking up where Matt left off, I really wanted to hit a couple things that are very exciting that we're working on. One is really around our cap stack in the fund and a couple initiatives that we're working on diligently there. And then to give a little bit of a view into what we think our cash flows in the fund will look like, picking up from where we are today, and then looking ahead once we close on some of the acquisitions that Matt just talked about in the pipeline. So just an update on where some of our debt sits today. That's what this slide is here. I know there's a lot of numbers on the slide because folks like to see a lot of details, so we wanted to provide as much detail as we could. But I'm really going to kind of focus on the takeaways for where we sit with our property-specific debt today. So we are currently working on refinance for 4 assets in the fund. There are 4 storage properties that we've bought, owned, and have executed on the value add strategy. And that's going to refinance some of the existing debt that we have talked about previously. So in total, we're looking at 4 properties in a CMBS execution where we have a term sheet for $8.6 million that we're working on. And I think a couple of the big takeaways is, one, as we pay off our existing debt on these 4 properties, we'll still net cash out of about $3.4 million. So what that's going to allow us to do is to take those net cash proceeds and redeploy them into additional acquisitions and drive cash flow accretion for the fund. The other big thing to note here is that because the CMBS market, which had been really difficult environment very early this year and last year, has really opened up. And underwriting has loosened up a little bit there. And the big thing is that spreads have really come down. And earlier this year, spreads, we were getting quoted in kind of the 300 range. And now for this set of 4 that we're financing right now with CMBS, those spreads are at about in the low 200 range. So they've really come in pretty meaningfully. So that's really nice in terms of generating value for the portfolio. And then the other important thing to note is that our pro forma interest rate, which you can see the second to the right column on the screen, is actually going to go down by about 27 basis points in aggregate. So our blended interest rate today is at about 6.4% on all of the debt that we have outstanding. And then once we execute on the current refinance, our pro forma interest rate, based on where rates are today, is going to drop by about 27 basis points to just over 6.1%. So we're getting cash out. Our interest rate is going down. And one other comment here on this slide, you can see our pro forma loan to cost all the way on the right. That's not loan to value, that's loan to cost for these assets. And to Matt's comment about how the storage properties are performing well, really what we're able to do on these four that we're refinancing is we're pulling out a significant amount of equity. And our leverage on just those four assets is about 82%. So what we're able to do and generate value with those assets and get cash flows up is really get the value of those assets up and extract the equity out of that through this financing. So that's a nice feature here as well. So moving on to the next slide, another piece of the cap stack that we're excited about that I believe is actually going to be closing today is we've been working on for some time a revolving line of credit. And for those of you that are invested in our Fund 3, this is a similar structure that we have in place for Fund 3. And just a quick summary of the terms, and then I'll kind of explain how it works. It's a $50 million line of credit. Will let us borrow between a range of 55% to 65% in terms of leverage. It has a spread, a rate of SOFR plus 275 to 3%, depending on various metrics in the fund. So that's the range of the interest rate. It has a 2-year term with an extension option, and the initial assets that will be pledged to the facility are really three on the previous slide that didn't have debt associated with them, namely Clover, Fairfield, and Osprey Huntsville. So with those, that's really going to take all but one asset in the portfolio where we've effectively have either current debt or the ability to borrow through this revolving line of credit. And we're actually planning, hopefully, to close this either today or tomorrow. And if you're unfamiliar with how it works, it's essentially a line of credit that we can use to really manage a couple different things. We can manage acquisitions. So one way to think of it is as a short-term bridge. So as we're looking to acquire new assets, we can draw on this facility, close those assets, execute our plan, and then go and put long-term fixed-rate debt on them. And compared to the cost that you would pay for traditional bridge lender, this is really attractive because the cost of the capital to do that under this structure is much more efficient and much lower than through traditional bridge lenders, which obviously is a big driver of value for investors in the fund. The other nice thing to do is it allows us to really manage our liquidity in a very efficient way. The fee loads on this kind of facility are very low. We're not really paying high entry and high exit fees like you would with bridge lenders. And to the extent that we do something down the road, let's say we refinance a property or let's say we sell a property, we could use those proceeds to pay down amounts outstanding under this facility with no prepayment penalty. So we can add new assets, take assets out very flexibly and very efficiently in terms of cost. So it really provides a lot of benefits to managing both our pipeline and our liquidity within the fund. And so we're very excited to close that, and I'm sure we'll put out an announcement once we close that here, hopefully today. So with those two pieces, let's move ahead to the next slide and just talk a little bit here about our cash flow projections for what we're looking for the rest of the year. So there's really 3 columns on this sheet. We just wanted to give you a flavor for how the current portfolio is performing, which Matt touched on, and how the portfolio will look through the balance of the year as we close these additional assets. So the first column in the middle of the page is really just outlining where the portfolio is running today. So our cash on cash after debt service is running at about the mid 7s, call it 7.4%. which is pretty strong, and I think actually a little bit ahead of what we had projected. So going from there, we have a number of assets in the pipeline that Matt just mentioned, and if we're able to close on all of those, we'll not only deploy additional equity that's coming into the fund in a pretty quick manner, but we'll also add additional cash flowing assets. And with those assets added to the portfolio, we'll be able to size up pretty substantially and continue to grow and scale the fund, more than doubling our revenue. And that, on our projected model, once we're able to execute on the value add strategy, would bring our cash flow and call it pretty similar in the low to mid sevens range. And then from there, as we close those additional assets that we have under negotiation or contract, we're constantly working new acquisition opportunities. And we close, we're trying to show you in this last column kind of what's the pathway to get to an 8% cash on cash, which is pretty close to what our blended preferred rate is in the fund. And to do that, we've got to close about another 60 million in additional assets for the balance of the year. So with what we have under contract and what we have for things that are not under contract and things that we're actively working, we're pretty confident that we'll be able to get there by the end of the year. So that's to give you really a sense for how much further do we have to go until we're more or less paying on a run rate basis anyway, what the full preferred for the fund is. So that's what that looks like. I think we've got a very good path to get there. And as we continue to close these assets and execute on the strategy, I'm sure we'll be back with more updates. But we're very excited to be able to lay that path out for the fund, given how early we really are in the life of the fund. And that these cash flows are really coming from, another question we get a lot is, these cash flows are really from operations of the properties. So we do cash reconciliations every quarter, and we're pretty excited that we're able to take these existing cash flowing assets, get them turned around, and increase them, and hopefully get to this full pref run rate really by the end of the year. So that's really what our goal is. So with that, I believe, we're open to the Q&A portion of the call.
I also will note that we will be sending out a recording of this, so you can always go back and rewatch the recordings here. And I just got a question, text in here. What is the current asset makeup of the funds now, and what is the target makeup as far as percentage of mobile home communities to self-storage?
Yeah, Mike, you want to take that? We could take that one together. I could answer the second half of the question, and then I could leave the more technical side to Mike in terms of what's the existing allocation. There's really no set goal nor mandate, as I mentioned a little bit earlier when we were talking about our acquisitions pipeline on this slide right here. We're really all about adding value at the end of the day and creating value for our investors and delivering outsized returns. However, that's going to fall in terms of a ratio to storage and manufactured housing communities. As long as we're following our disciplined acquisitions approach and our underwriting approach, we're kind of okay wherever the chips fall. With that being said, take a look at this acquisition pipeline for a moment. You could see it's 100% allocated at this point to MH. If we're successful in taking down all of these targets, I mean, that ratio is probably going to be 75% plus from an NOI perspective skewed towards MH. So this is going to be a heavily weighted MH fund, at least during the near term. That could shift where we buy a large storage portfolio in the future. It's hard to make the determination of how we're going to shake out, let's call it 2.5 years from now. But one thing you could be certain of and take solace in is that we're only going to do things that are going to be accretive for the investors and the fund, and wherever that might fall, whether that's MH or storage. With that, Mike, I don't know if you have the existing allocations for storage and MH.
I do. So with the portfolio that we have closed to date, so where we stand right now, believe it or not, we're actually at 50-50, like 49.2, 50.8 based on purchase price. So pretty close to 50-50. And then to Matt's point, the portfolio is really MH, exclusively MH. So as we can close these assets, that MH percentage will obviously rise from here.
Great. I have a question here. Can you explain footnote number 5? And let's jump over, I believe, to this slide here. Cash on cash calculations exclude any CapEx. Mike?
Yeah, I'd be happy to take that. We're aware different sponsors present return metrics and cash on cash metrics a little bit differently. What we did, we didn't include CapEx from an operating income perspective. What I mean by that is we didn't subtract CapEx from our net operating income. And just to give you an example, so in our Mountain Vista property, for example, where we put in a pretty significant amount of CapEx into that property, typically what we've done is that CapEx is essentially equity into the property. So if we've done some paving and done some painting, new signage, et cetera, that really is additional equity basis in our property. So what we didn't want to do is take our net operating income and then from that just subtract the amount of CapEx into the property. So that's the intent of that footnote, is that we're really looking at the net operating income after debt service, but CapEx is really getting added to the basis of the asset through equity.
We have a question here on cap rates. What have we underwritten to as far as cap rates go, and what is our future assumption on where cap rates are going?
Well, let's go back to slide 4. You could see here we've underwritten to an in-place cap rate on the existing portfolio of roughly 4.6. With that being said, depending on the degree of value add and the different opportunity, I think there's going to be a range there. I mean, we've underwritten investments that, believe it or not, have been 2 caps, and we've got a track record of taking them to 8 to 10 caps within 12 months of our ownership. So it's really not a going in place cap rate that's important to us. It's really where can we create value and what's the cap rate going to be? Let's call it 6 to 12 months from now. You could see right now, on a forward-looking basis, we're at about a 7.2% cap rate on our existing portfolio based off the value add initiatives that we've already executed upon. Our projection of where cap rates are going, I mean, there's so many. I'm not even going to go out on a limb and try to predict that one. There's so many different elements that are going to flow into that projection or that extrapolation, if you will. Some of the best investors of the world can't predict where interest rates are going to go. And I think, where interest rates are going is going to be a big driver of where cap rates are going to be, let's call it 6 to 12 months from now. So if you don't have the first part of that equation, I don't think you could effectively predict where cap rates are going. And since I can't predict where interest rates are going, I'm just going to focus on creating relative value for our investors across the portfolio today. Mike, you want to take a crack at where you think rates are going to be 6 to 12 months from now?
Well, they're either going to be higher, lower, or the same.
Okay.
So the answer I always give. I think the other, probably what's underlying that question is in our underwriting, kind of what kind of exit cap rates do we use? And we really run a range of scenarios within our underwriting models. I would say generally sort of a blended average. We really aren't going below 6.5 in terms of what our exit cap rate assumptions are. And, they're more typically going to be 7% plus. And that really is going to vary based on the asset quality, the geography, asset type, availability of financing, the various levers that really drive the asset's value at the end of the day. We'll kind of tweak those cap rates up or down. But, very rarely are we assuming anything below a 7, which, given where interest rates have been historically and the spread between cap rate and interest rates, there's still a decent spread there, even if interest rates continue to rise and be elevated. But where they are in a year, very difficult to predict. And that's one of those things that I say where our job is not to speculate on where interest rates are. Our job is really to insulate ourselves from interest rate risk as much as we can within the portfolio by doing things like terming out our debt kind of that I hit on with some of the CMBS financing that we're working on, so that we've got 10-year fixed rate debt, interest only, which I should have mentioned, over the term of those loans, which is the terms that we're getting today. And so that lets us really lock that in and protect our cash flows coming off of the asset for a significant amount of time.
Yeah, that's a good point.
Great. All right. One of our last questions here. One of my favorite questions is, if I fund today, how quickly can you deploy my capital? So Matt, would you speak to that?
Yeah. So our next acquisition, which is set to close, by the way, within the next 2 weeks, if that happens in the time frame that it's supposed to, the answer to that question is about 2 weeks or less. So there's nobody in line ahead of that individual at this stage. So it's going to be a very quickly capital conversion process. And so those folks that have been sitting on the sidelines, not wanting their capital to sit in a subscription account, I think that concern shouldn't really cross your mind. And especially, let's take another look again at that acquisitions pipeline. I mean, once we start to take down these different opportunities, I mean, that capital is obviously going to be converted to equity very, very quickly.
Yeah, great. A question here: what percentage write-off on investment might you expect in 2024?
I can take that one. Sure. So a couple comments. With the assets that we've closed, both this year and what will likely close the rest of the year, manufactured housing generally has a higher year one bonus depreciation than self-storage. And I think everybody's aware of this, but what we do for all the assets that we close, we hire a consultant who performs a cost seg, which lets us accelerate the depreciation. There's a sunset in that year one bonus depreciation under current law that we're able to take. I would say under current law, a decent estimate at this point in the year, which we're only halfway through and still have a lot to go, is probably in the 25 to 50% range. Now that could potentially change. Who knows where the election's gonna finish, and maybe there'll be some changes early next year when we're working on the tax returns for 24. But I think that's a reasonable expectation as of today.
And along those same lines on taxes here, how many state filings do we expect? And do we have any efficiencies that we offer our investors?
Yeah. So the tax filings, the number, if I had to guess, will probably be in the 10 to 15 range. Again, that will depend on exactly what comes in between here and the rest of the year. But what we offer on the tax efficiencies is, in any state that we offer a tax composite return, which is we will send out a form that says, here's all the states that we are in. Would you like to participate in a composite to the extent that you can participate? And what the composite is that's essentially us completing your tax filing obligations at the fund level instead of you having to file your own. We'll send you a reporting package at the end of the year that has all of the details in it by state. But rather than you having to pay your CPA to file in all of the states that we have, we will use that composite to basically complete your filing obligation. Not every state has it. There are different rules for coming in as an individual, for example, versus an entity. But that's something that we offer that I think is a nice benefit to you, the investor, to help manage that. And one, the complexity of it, and then two, to keep your costs down as you're actually filing your own returns.
Well, thank you, Matt and Mike, for presenting. And thank you for hanging with us the whole time and watching this webinar. If you're interested in investing, please reach out to us. So there's two easy ways that you can do this. Either you can go to our website, click on Fund 4, and let us know that you're interested, or you can just email us directly at invest@crystalviewcapital.com. Either way, you can let us know. We'll reach out to you. You can also schedule a call if you have more questions. That's all right as well. We would be happy to chat with you. So thank you for taking time again, and we look forward to connecting with you.